Welcome back to Alternative Angles, the Fidelity podcast where we hear from investors about strategies outside the realm of conventional stocks and bonds. I'm Steve Rosen, and I'm your host. Here's a question that's likely not top of mind, but the answer goes to the origin story of commercial mortgage-backed securities. What do castaway Alexander Selkirk, inventor Mary Anderson, and former baseball executive Billy Beane have in common with the Resolution Trust Corporation, the RTC? On quick consideration, seemingly nothing. But it struck me that they are linked by the common proverb, necessity is the mother of invention. Selkirk improvised to survive for years on a deserted island. Anderson devised the windshield wiper to make dangerous driving conditions safer. Billy Beane turned to data analytics to build a competitive roster for a financially strapped franchise. And when the RTC was established in the late 1980s to address the savings and loan crisis, it also faced an urgent problem: how to efficiently liquidate commercial real estate loans and restore confidence in a moribund market. The solution was innovation in structure, risk allocation, and investor access through the issuance of commercial mortgage-backed securities. Formed out of crisis and refined through multiple cycles, the CMBS market has since evolved into a mature asset class and a meaningful source of capital for the real estate industry. With me today to explore the story is Matt Torchia, a Fidelity portfolio manager and a former colleague of mine. Matt brings multiple perspectives from his nearly 20 years of experience working in different facets of commercial property debt. He started out on the sell side, first in loan originations, and then as a CMBS credit trader, and then he moved to the buy side as an analyst and is now a fund manager. During our conversation, I'll ask Matt to cite historical investment examples. Bear in mind that any companies, securities, and properties named are for illustrative purposes only and are not necessarily holdings of Fidelity products, and reference to them should not be construed as either a recommendation or investment advice. Matt, welcome to Alternative Angles. It's good to see you.
Hi, Steve. It's great to be here. Thanks for having me.
Of course. So to start us off, I'd like to hear about your background, and I want to know, how was it that all those years ago, as you were graduating from college as the Centennial Conference Player of the Year, you decided to leave the gridiron behind and turn pro on Wall Street, which eventually led to your role here at Fidelity?
Well, I didn't anticipate a resume on my football career, but thanks for bringing that up. It was Division III, so we don't need to get too excited. So just for the love of the game there, but maybe more to the point on my background. So yeah, I started off my career at Bank of America in their CMBS origination or capital markets group. Steve, that was August 2007. So clearly an interesting time to start, a career for anyone who was in finance, particularly given what we all know happened about a year later. But I'd say even more so for anyone in the securitized product sector, particularly CMBS as well. I learned a lot through the restructurings that occurred during and in the aftermath of the global financial crisis. And I was able to ultimately see the restart of the market and was a part of the newly originated loans when the CMBS market picked back up in 2010 or 11. As you mentioned, I did, during my final years at Bank of America, I moved down to the secondary trading desk where I focused on credit sensitive parts of the CMBS capital structure. Eventually, I did leave Bank of America in 2014 to join Blackstone's real estate debt group. The team that I was a part of within that group was predominantly focused on liquid real estate debt securities, investing on behalf of various types of capital. In 2021, as you're obviously pretty familiar with, Steve, an interesting opportunity within Fidelity's real estate debt group opened up, and I did ultimately make the decision to move my family up to Boston from New York and join the team. And maybe a quick side note for those wondering, I am still a New York Giants fan. I will not be converting to a Pats fan. And as you mentioned today, I'm a portfolio manager on our public and private real estate debt vehicles.
Okay. Well, despite the fact that you root for the football Giants, I remain willing to continue this conversation. So how about if we segue from that team to the one that you've been a part of now for several years and investing on behalf? So why don't you give us an overview of the real estate group?
Sure. So the real estate debt group at Fidelity can actually trace its roots back to 1994. So 30 plus years of investing in the space. And, it's always hard to track this perfectly, but I'd say the Fidelity Real Estate Debt Group is one of, if not the longest tenured real estate debt team in the marketplace. And we sit within Fidelity's high income and alternatives division. And I describe the business as really broken into three main verticals. Two of those verticals are focused on public markets, while one is more focused on private markets. Maybe just a second on the public market focused verticals. One is a bit more focused on, let's say, across the capital structure. So, real estate securities, both debt and equity. The other, which is, I'd say, the focus of our conversation today, primarily invest in what I'd call public high yield or credit sensitive real estate debt, which mainly takes the form of CMBS. Said another way, our focus within our group is on the middle to bottom part of the debt capital structure. The third vertical is a private debt business where we directly originate private real estate loans. All told, we have a 14-person team dedicated to real estate debt. I think what's interesting and compelling is, you could almost say we're a bit of a boutique, a 14-person team, but can take advantage of all the benefits of being within a large asset manager such as Fidelity.
Okay. So, as you mentioned, your focus on real estate debt in the public markets and more specifically CMBS. So we're going to talk a lot about CMBS today. So why don't you just give us a refresher on the asset class?
Sure. So why don't I start out with a quick description of the structure first, and maybe we can go into a bit more detail. So to create a CMBS, it really starts with a lender, and a lender originates one or more mortgages, and those mortgages are secured by commercial property. Then with, let's say rating agency oversight, the loan or pool of loans is structured into bond classes, or what we refer to as tranches. And those tranches have differing levels of risk and return. The structure typically starts with AAA ratings at the top and moving down from there. Now, principal repayments on loans go sequential, so top down, and any losses on the loan or pool of loans would go from the bottom up or reverse sequential. After the structuring is complete, any number of the Wall Street investment banks sells these bond tranches into the open market in a new issuance, and then those bonds obviously trade in the secondary market over time. But to go a little bit deeper for everyone, so to give you a context on market size, total outstanding CMBS market is about $635 billion. But I think at the end of the day, and in its simplest form, Steve, CMBS in my mind is really just a liquid form of commercial real estate debt or mortgages. With that said, I think anyone who's new to the market, it's really important to understand that there are two main forms of CMBS. Those two forms are known in the marketplace as conduit and single asset, single borrower. For those with a bit more knowledge of CMBS, you may hear it referred to as SASB. For the purposes of this conversation, we'll just call it single borrower. There are a few differences between each segment, but the main difference is that single borrower bonds are secured by one loan and typically one property, or one property type, that is. Whereas conduit bonds are secured by a pool of multiple loans or mortgages, and they're across various property types. So a good example of a single borrower CMBS is a transactions that could be backed by a portfolio of warehouse buildings owned by an institutional sponsor. On the conduit side, the pool of loans is diverse in terms of geography, property type, and borrower. Usually these days, the pool consists of anywhere from 25 to 50 loans in total. But as you alluded to, Steve, earlier, the CMBS market has gone through a pretty big evolution over the past 5 to 10 years, and in particular, the last 5 years. So while the single borrower segment of the CMBS market has been around for a long time, it has really emerged as the main structure issued within the market today and is actually approaching 50% of the total outstanding share of CMBS. And to give you a bit of context, so that's actually up from 29% in 2019 and 17% in 2015.
Given that description you just gave of the asset class, and then previously you talked about your career history, let's move forward and have you describe for us your investment philosophy and how it was shaped by your experiences on both the sell side and then the buy side.
Yeah, sure, Steve. So as I said, I started my career out on the origination side of the business. So, really digging deep on the underwriting of individual loans. And I ultimately think that helped to start to form the basis for my approach to the market, which is a belief in deep credit research. So this means fundamental bottoms up kind of approach to the market. I think unlike many other structured products or securitized products, CMBS outcomes can be highly idiosyncratic. This ultimately leads to, in my opinion, an inefficiency in the market where, if you have the right amount of resources and a high quality experienced team, you could take advantage of those inefficiencies. A CMBS credit investor, it's at least my opinion that you can't take a pure model based approach. And maybe let me elaborate a little bit more. And what I mean by that is let's just take the RMBS market where, bonds are backed by single family mortgages, and those pools tend to be very granular, thousands of loans, and the collateral is pretty homogeneous. You can build models based off of home price appreciation curves, and borrowers can, tend to exhibit similar behavior depending on the economic and interest rate environments at any given time. So you can run a big scenario, Black-Scholes model could spit out 10,000 different scenarios, and you could sort of feel like you have a pretty good sense as to how your bond's going to behave across a wide range of scenarios and outcomes. In CMBS, it's scenario 10,001 that might be the run that truly impacts you and impacts your investment, and that's because the pools are just less granular. I mentioned 25 to 50 loans in a conduit pool and a single borrower, it's just one loan, and the collateral is heterogeneous. So how a commercial real estate property is going to perform will vary significantly based off of quality, location, property type, and borrower, for example. I think the point here really is just to say that loan by loan work is required because the dispersion of outcomes can be large.
Okay. So Matt, as you laid out for us a little earlier, the CMBS market offers investors risk reward choices in a senior subordinate structure with all the tranches backed by one or more first mortgages. So it could be construed as defensive since you have that first mortgage collateral. But to play devil's advocate, in a stressed environment, as we know, prices typically fall. And in CMBS, the collateral might provide less protection to subordinate tranche holders than some might have expected. So tell me about how you go about evaluating credit quality of a CMBS, which seems to be pretty important given where you participate in the capital stack.
Yeah, definitely very important. The investment, let's call it evaluation process, can really be broken down, I think, into two main categories, and in no particular order here, but one is a view on fundamentals. So how are we feeling about a particular property type in a certain market is obviously very important. Having a good understanding of the supply and demand picture can really go a long way. This is what I call more of an iterative and ongoing portion of our work. But when we discuss fundamental work or that bottoms up approach, again, I just want to stress it includes loan by loan work. So that means coming up with a valuation on each underlying asset for each loan. Our team is really encouraged to do site visits or to actually go see the underlying properties. And it's been my experience that nothing really replaces actually seeing the asset. And you tend to come away with just a higher level of conviction in your views post seeing the asset. And they could be positive or negative, but just a higher level of conviction. But we talk to management teams and brokers in the various markets. We're going to analyze rent rolls. So who are our tenants? How long are the leases in place? And really just trying to come up with what is our view on the future, NOI growth of a particular asset or portfolio of assets. So that's the fundamental side. The second part of our process is effectively overlaying the capital structure on top of our fundamental work. So when we evaluate capital structures, we're looking at, how levered a particular single borrower deal is. So loan to value, cash flow coverage are important metrics that we pay attention to. In Conduit, we look at, what is our forecasted loss for a particular pool and how much credit enhancement does the bond have that we're evaluating. And just to pause for 1 second, for those not familiar, credit enhancement is the percentage of the pool that sits subordinate to your investment. But we also pay close attention to what percentage of the capital structure our bond represents. This is known as thickness. But because CMBS is tranched into various classes, this creates structural leverage, which I think is kind of what you're getting to, Steve, which just means that outcomes for investors at the top and bottom of a particular deal could be different. So as credit investors, we just need to be aware of that. But ultimately, I think with our capital structure analysis, we're trying to determine, our margin of safety.
Okay. Now, all that credit work that you do is in the context of market conditions, and they change. And you certainly used the word fundamentals a few times in the answer you just gave. So tell us, in your view, what is the current state of commercial real estate fundamentals?
Yeah, I think in short, overall, commercial real estate fundamentals are sound. I think if we use data available through the publicly traded REITs as a bit of a barometer, occupancy is obviously very important, and those figures are hovering around the long-term average in the mid 90% range, and same store NOI growth is also solidly positive. Another important aspect is new construction. So new construction supply as a percentage of the outstanding stock has actually come down to levels that are just below historical averages. However, many of these data points, to be fair, have shown what I call a bit of a normalization, let's say, in growth rates after what was a bit of a big run post pandemic or post COVID. So I think today you really can't make blanket statements on specific property types now, and I think it kind of goes back to that old adage, Steve, of in real estate, location, location, location. So let's talk about maybe two anecdotes. Let's say the multifamily side or apartments. They had a very good run, and particularly in the Sun Belt, while there was in-migration and therefore demand for apartments in those markets, we also saw overbuilding. And the supply has been weighing on rent growth and increasing vacancies in some markets. Another much discussed property type over the past 5 years has been office. And office is what I call a bifurcated market today. And maybe just to bring it back to the CMBS market, Steve, I found this actually pretty interesting. So last year, office was the most issued property type in the single borrower market. But at the same time, you look at delinquencies in the conduit market, office-backed loans are at the highest delinquency rate dating back to 2004. So in my opinion, what this really just highlights is there's haves and have-nots. So security selections is clearly key.
All right. Now, in addition to the property fundamentals and credit analysis that you just spoke of, another important element to consider, of course, is the quality of the loan underwriting backing the CMBS transactions. So tell us, what is the state of loan underwriting today, and how does that compare to history?
Yeah, I think I'd say what's interesting about the market today is while we as the CMBS market have been having record issuance years, if we just look at the period of time post great financial crisis, we see underwriting as in check. I think an astute investor, when they hear a market is having record issuance years, might also think underwriting is stretched. But again, as I said, that is not the case today, in our opinion. And what's nice about the CMBS market is, we do have access to good historical data. Maybe one data point to sort of encapsulate underwriting is loan to value, or LTV. Last year, average LTVs on conduit loans were just over 55%. This is lower than all pre-COVID vintage averages. Now, to be fair, underwriting has loosened from what was a historically tight lending environment in 2023 after the regional banking crisis, but we still have lots of equity cushion in these newly originated loans.
And as you alluded to, conditions change through time. So give us a sense of how you're underwriting the refinancing and extension risk of some of these loans in a market where property values and debt costs have in fact reset over the last few years.
It's a really great question, Steve. And that dynamic of declining property value and rising debt costs has definitely created some angst in the marketplace. And this issue, I'd say, is most acute for more seasoned vintages where, loans have been maturing over the past few years. And maybe just to pause for a second there, vintage is an important concept in CMBS. And it just refers to the year in which a loan was originated. You can see why that might be important because those loans originated in any given year are done so with valuations at the time and underwriting standards also in that given year. So again, getting back to your question. So first off, you're definitely right. Property values, if we use the Green Street index that we like to cite, are down on average about 16% from the peak in early 2022. Now they've recently stabilized though and are up about 7% from the bottom. At the same time that, higher rates were impacting property values, coupons on new loans were also going up or have been going up. And to give you a sense, loans originated in 2014, 2015, 2016 had coupons around 4.5%. And market coupons over the last few years have been in the mid 6% range, so about 200 basis points higher. And so the reason why I picked those vintages, Steve, our conduit loans typically have 10-year terms. So 14, 15, 16 have, natural maturity dates in 24, 25, 26. I would say the good news for borrowers is that we are starting to see coupons come down from that mid 6% range. So at a very high level, maturing loans have been facing lower property values and higher debt costs, no doubt. And we did see a decline in on-time repayment rates during this past few years, and on-time success rate bottomed in 2024 and into early 2025. Again, it has started to increase, but this is where that work, that loan by loan work, comes into play. We dial into property values and potential losses, as well as estimate, the timing of repayment. So, and I think sort of a sub question that you were asking there, Steve, was, how did we address this dynamic? Not shocking. I don't think this is just unique to CMBS, but the pendulum tends to swing pretty far when there are market shocks. And we saw the market pricing in rather large extensions. And that could be a potential opportunity, especially if debt markets recovered and or refinancings, picked up, because a lot of these securities, given the increase in interest rates from 2022, were all trading at discounts to par. So a faster than anticipated outcome or repayment would be a benefit to the return of your bond. So the way we addressed it is really depends on the type of CMBS. In conduit, we looked up the capital structure, particularly in more seasoned bonds, where, again, as I mentioned earlier, that dynamic was most acute. So that addressed two things. One is the value decline that we saw in properties. So we went up the capital structure. And it also means you don't necessarily need to wait for the very last loan in a pool to repay in order to pay off your bond. In single borrower, I think the approach is a little bit different. And I think it just comes down to picking the right property types. So if cash flows keep growing, which for many property types they didn't, for some they didn't, the hope there is that the cash flow growth outpaces declines in valuation multiples or cap rate widening, which should allow for an on-time repayment or even early repayment. That's kind of what played out. So if you just look at floating rate single borrower bonds issued in 2021, about 1/3 have repaid at least 1 year prior to the maturity date. And a floating rate CMBS typically has a 5-year maturity, Steve. So 2026 or this year would be their natural maturity date. 1/3 repaid at least 1 year early. But again, to my point on property type, you have to dig a little bit deeper to understand, how that 1/3 is split. Only 4% of office deals repaid early, while nearly 2/3 of bonds that were backed by industrial property have already paid in full.
Wow. Okay. So really quite a disparity there. And I guess maybe not so surprising given what we've been reading about over the last few years. With that, Matt, I want to take a temporary detour from CMBS because while your strategy is focused on it, you've also got flexibility to invest in other instruments such as bonds, preferred stocks, and leverage loans issued by real estate companies. So tell us about your approach to investing in these other asset classes.
From my standpoint, I'd say the fundamental analysis of the underlying business or the valuation of the collateral is ultimately the same, whether it's CMBS or another market. And I'm somewhat, and I say somewhat, agnostic to the wrapper in which we invest. However, each market does have its own nuances and attributes, and we have to take that into account. At the end of the day, I think we are just trying to search for the best return while taking the least amount of risk. But we must keep an open mind to opportunities that exist outside of our core CMBS markets. I can think of a situation not too long ago where a company just happened to choose to finance itself in the leveraged loan market. It was a higher yielding opportunity and a property type that we had some conviction, so we took the time to underwrite that investment. So, and there are many other examples of that I could point to, but we do need to keep an open mind. But at the end of the day, the fundamental analysis is really just the same.
Let's move to a question I think could be important to a number of our listeners. Let's talk about why an institutional allocator would consider investing in a high yield CMBS oriented strategy. That's an asset class that some think of as kind of a niche asset class. So, what does it offer allocators, and where do they tend to categorize it within their portfolios?
Yeah, that's right, Steve. It can be seen as a niche asset class. So, it's not necessarily the case that an institutional investor is going to wake up any day, thinking about CMBS. But we do think there are various attributes and things that CMBS can offer allocators of all types. Over the years, we've seen institutional investors categorize the strategy in various ways and place it in various buckets at their respective institutions. But I think a CMBS strategy, a high yield CMBS strategy that is, acts as a nice complement to two main buckets or strategies. I think the most common use case that we see is as a complement or diversifier for a liquid credit allocation. So, from a valuation standpoint, today most liquid asset or credit asset classes are trading, at or near the tights on a spread basis. That is not necessarily the case in CMBS, where it's not the easiest asset class to benchmark where spreads are, but the ones that we use, which look at a broad swath of the CMBS market, are trading at historical averages or in even some cases a little bit wide. So for an allocator, there's a yield or spread pickup, which is clearly a nice advantage. Another benefit we've noticed is that a high yield CMBS strategy has shown what I would call diversification enhancing traits. When we look at correlation, say over the past 3 to 5 years versus traditional fixed income like Bloomberg Ag or fixed income plus sectors such as the high yield market, leverage loan market, emerging market credit, correlations to our strategy have ranged from zero point 0.4 to zero point 0.6. Now, one potential drawback for an allocator is that you are taking, concentrated commercial real estate risk, which in a year like 2023, you may not have wanted to have commercial real estate risk. Whereas some of these other markets can be a bit more diverse in their industry exposure. The other area, which historically has been a little less common, but has become, I'd say, more top of mind recently, is acting as a complement to an investor's real estate or real assets allocation. For a real asset allocation, a high yield CMBS strategy offers nice current income, but with the potential for less risk as you're moving up the capital structure into debt versus what I would generally traditionally consider as an equity focused allocation. Investors, I think, also appreciate the liquidity that is offered here versus again, which is historically and traditionally a more illiquid bucket where there might be drawdown vehicles or closed end vehicles. One drawback would be, that debt naturally has less potential upside versus, say, an equity investment. As us, bond buyers only get back par plus our coupon, but that's kind of how I would think about how it fits for an institutional allocator.
Now, earlier in the conversation, you referred to your group or team as a bit of a boutique, yet you sit inside a very large and highly resourced asset manager. But the capital you're running is at a scale that allows for nimble security selection. So, what parts of the broader platform help you as you execute on the strategy?
I think the short answer is they all matter, Steve.
Okay.
But one thing worth pointing out here is what really surprised me when I arrived at Fidelity was this concept of a open meeting policy effectively. And so all meetings with companies and management teams are made available to all investment professionals. And so this sharing of information on a real-time basis is really valuable and helpful to our process, especially as information is changing quickly these days. Analysts across the platform definitely offer some great insights. Maybe to give you a few examples. So, we have a dedicated REIT equity team who we work closely with comparing notes. Data centers, been a hot topic recently, right? And we have analysts covering every part of the data center supply chain. Maybe a little bit closer to home within our high income and alternatives division, our high yield corporate bond analysts offer great views on some of the tenants in the buildings that serve as collateral for our bonds. And then the trading desk. The trading desk is vital to getting our strategy executed. And our desk trades the entire CMBS capital structure in conjunction with our colleagues in the fixed income division who generally focus at the top of the capital structure, which creates some nice synergies. And, not surprisingly, we're a top counterparty to Wall Street. And then let's not forget, within our real estate debt team, we're active in the private market as well. So again, clearly plenty of insights and synergies that can be created there.
Well, given those resources, how about if you walk us through a CMBS investment example where synergies among parts of the platform you just mentioned could give us a sense of your investment process?
Sure. So one that comes to mind was the acquisition of Medline Industries by a consortium of private equity firms back in 2021. Medline, for those who don't know, is a manufacturer and distributor of healthcare supplies. And so to finance the LBO, the sponsors took out leveraged loans and high yield bonds. The company also owned a bunch of distribution facilities, which ultimately became the basis for a CMBS bond offering. The CMBS was backed by these warehouse facilities and was 100% leased to Medline. So we started out with our typical baseline real estate analysis for warehouse deals. In this particular case, we're focused on what rent was Medline paying compared to our view of market rent. How specialized were these facilities? Could they be re-tenanted if Medline ran into financial trouble? What was the quality of the assets and what markets were they in? But with all that said, clearly the health of the tenant was vital to the story here. And this is where our high yield corporate bond analysts came into play. We had discussions with them as they were digging into the LBO debt offerings. And I guess I'd just say our analysts' favorable view at the time was added conviction to our positive view of the real estate. Ultimately, the CMBS was paid off in full in 2024.
Okay, so it sounds like a good outcome for you. But what about maybe another example where the fundamental backdrop changed for the worse? And what did you do?
Sure. So we had an exposure to a deal that was backed by a San Francisco hotel owned by a high quality sponsor. Not surprisingly, during the pandemic, all hotels got hit pretty hard as no one was traveling or leaving their homes. But we were noticing a pickup in demand drivers for leisure-focused hotels as we started to come on the other side of the pandemic. However, also based on our analysis, as well as observations from being on the ground in San Francisco, for a variety of reasons, one of which was slower forward bookings for conventions, it felt as if the A recovery in San Francisco was going to be much slower and delayed versus other metropolitan areas. The bond in question here was actually coming up on its maturity date. And the market, in our mind, at least the market price, was implying that the bond wouldn't pay or repay on time, which was consistent, I'd say, with recent comments from the sponsor. But in our opinion, also implying that there wasn't that much risk to principal loss. We felt that between extension risk as well as a risk that cash flows just might never get back to where they were pre-pandemic, it might be a good time to sell. We actually had two classes of subordinate bonds that we ultimately decided to sell. And I'd say the situation ended up probably being worse than what I would have originally anticipated. And the loan ended up defaulting at maturity, and the sponsor has since walked away from the asset.
Okay, so sounds like it wasn't your best investment, but it could have been worse.
Yeah.
Yeah. Okay. Well, we're getting close to time, but I want to ask one more question that sort of speaks to how you maneuver through these markets or the market. So given that the tranche size of some credit-sensitive CMBS can be small, and therefore the bonds might trade only episodically after new issuance, to what degree does that impact how you think about portfolio construction? And then also, if you could add, how is it that you're ready on short notice when there's an opportunity to bid on a bond that you'd like to add to your portfolio?
Yeah, that's right, Steve. I think I'd say some credit CMBS tranches can be relatively small in size, so therefore don't trade often. We do source bonds in both the primary and secondary markets, and again, our trading desk really gives us an advantage here. Now, while things do ebb and flow over time, we do find that the secondary market is where some of the most fruitful opportunities can arise. In a new issue transaction, it clearly feels nice when you and a bunch of investors have effectively confirmed and everyone's set a market price for a new deal. But it can be more difficult for investors to evaluate a secondary market opportunity where a deal may have been issued years ago and there's so much to catch up on. And I think this is where, having the right team, being, well staffed and well resourced does have its advantages. And we're just updating our work on all of our deals, so that we are ready to move when these opportunities arise. On the portfolio construction side, at a high level, I think there are a few main, I guess what I call dimensions that you can toggle within a strategy like this. One would be investment type. So CMBS versus real estate corporate bonds. But within CMBS, you're more favorable on single borrower or conduit. Property type is obviously another major dimension. Our goal ultimately is to invest in sectors where, we see structural drivers for NOI growth. But our main tool in the toolkit for effectuating, these changes in property type is through the single borrower market, saying yes to certain property types or deals while not investing in others. On the conduit side, we don't shape the pools, so it's a little more difficult to exactly pick and choose property types. However, what an investor can do and what we do in conduit is change, our position in the capital structure, i.e. higher or lower depending on, our underwriting of a particular deal. We also evaluate vintage or the year in which a loan was originated. And as I alluded to before, that can have a pretty big impact in the conduit market. It also tends to be the case that, newer vintage transactions or more recently issued transactions or a bit more beta, if you will, and versus say, that example that I said years ago, a deal was issued, more seasoned deal, it can be a bit more deal specific, the outcome of that bond. Position sizing is really just dependent on conviction level, but you tend to see larger average position size in single borrower because credit class sizes are just much larger than conduit. That's kind of the simple answer. But what I'd say that what excites me about CMBS in the market today for a credit investor is that we have lots of choices and therefore can be selective. So As I mentioned, single borrower and conduit are almost 50-50 in terms of their market share. We have bonds structures that start at 5-year floating rate and can go all the way out to 10-year fixed. We have a big seasoned bond market. We have a big new issue bond market, all of which, as I've described, have their own dynamics. So while we invest the day-to-day core, we can really wait for the right opportunities to add that, higher yielding alpha, let's call it. And I think having that ability to be selective can potentially lead to better portfolio credit quality and outcomes over time.
Well, Matt, I think you've shared a lot of great insights, and I appreciate you taking the time. Thanks so much.
Thanks for having me, Steve. Really appreciate it.
This podcast is intended for institutional investor and investment professionals only. Information presented herein is for discussion and illustrative purposes only, and is not a recommendation or an offer or a solicitation to buy or sell any securities. Views expressed are as of February 2026, based on the information available at that time, and may change based on market and other conditions. Unless otherwise noted, the opinions provided are those of the speakers and not necessarily those of Fidelity Investments or its affiliates. Fidelity does not assume any duty to update any of the information. Unless otherwise expressly disclosed to you in writing, the information provided in this material is for educational purposes only. Any viewpoints expressed by Fidelity are not intended to be used as a primary basis for your investment decisions and are based on facts and circumstances at the point in time they are made and are not particular to you. Accordingly, nothing in this material constitutes impartial investment advice or advice in a fiduciary capacity, as defined or under the Employee Retirement Income Security Act of 1974 or the Internal Revenue Code of 1986, both as amended. Fidelity and its representatives may have a conflict of interest in the products or services mentioned in this material because they have a financial interest in the products or services and may receive compensation, directly or indirectly, in connection with the management, distribution, and/or servicing of these products or services, including Fidelity funds, certain third-party funds and products, and certain investment services. Before making any investment decisions, you should take into account all of the particular facts and circumstances of you or your client's individual situation and reach out to an investment professional if applicable. References to specific companies or investment themes are for illustrative purposes only and should not be construed as recommendations or investment advice. Investment decisions should be based on an individual's own goals, time horizon, and tolerance for risk. The securities mentioned are for illustrative purposes only and not necessarily current holdings invested by FMR LLC. References to specific issuers or securities should not be construed as recommendations or investment advice. This piece may contain assumptions that are forward-looking statements, which are based on certain assumptions of future events. Actual events are difficult to predict and may differ from those assumed. There can be no assurance that forward-looking statements will materialize or that actual returns or results will not be materially different from those described here. Alternative investments are investment products other than the traditional investments of stocks, bonds, mutual funds, or ETFs. Examples of alternative investments are limited partnerships, limited liability companies, hedge funds, private equity, private debt, commodities, real estate, and promissory notes. Some of the risks associated with alternative investments are: alternative investments may be relatively illiquid. It may be difficult to determine the current market value of the asset. There may be limited historical risk and return data. A high degree of investment analysis may be required before buying. Costs of purchase and sale may be relatively high. Stock markets, especially foreign markets, are volatile and can decline significantly in response to adverse issuer, political, regulatory, market, or economic developments. Foreign securities are subject to interest rate, currency exchange rate, economic, and political risks. Securities selected using quantitative analysis can perform differently from the market as a whole as a result of the factors used in the analysis, the weight placed on each factor, and changes in the factor's historical trends. Securities lending involves the risk that the borrower may fail to return the securities loaned in a timely manner, or at all. If the borrower defaults on its obligation to return the securities loaned because of insolvency or other reasons, a fund could experience delays and costs in recovering the securities loaned or in gaining access to the collateral. Past performance is no guarantee of future results. Investing involves risk, including risk of loss. Fidelity Investments provides investment products through Fidelity Distributors Company, LLC, clearing, custody, or other brokerage services through National Financial Services, LLC, or Fidelity Brokerage Services, LLC, members NYSE, SIPC, and institutional advisory services through Fidelity Institutional Wealth. Advisor LLC, copyright 2026 FMR LLC, all rights reserved.